Greetings, Algo artisans. Can traders make money if they know the future? Actually, it does happen, and we're going to talk about that in today's show. How do big banks, hedge funds, and asset managers make money? By scaring you out of yours. Before we get into that, please like, subscribe, hit the notification bell, follow me on X. That helps me get more of this content out to you. Okay, so first we're going to start with banks. How do banks make money? And there's an article here from CFI, and it does list out three main ways that banks make money. There's interest income, capital markets income, and fee-based income. And we're going to focus on interest income. The very basic way the banks make money is, first of all, they bring in depositor money. They attract depositors. Depositors can put their money there. The money's going to be safer maybe than under your mattress, depending on how you look at things. And they will give you a small return for holding your money. Now, what they will do is take those deposits and they will loan them out to people at a higher interest rate, and oftentimes a significantly higher interest rate, especially in today's environment. So that will be a sort of arbitrage, if you will. It's kind of a spread. So they might be paying 1% and then they're getting 5%, making a net of 4%. That's how they make money. Now, why is that important to today's conversation? It's because it frees up money for people to invest. And in order for the hedge funds and the asset managers to make money, they need to have retail investors going in. They need to have mom and pop, which is in a very combined sense, a large amount of money, and they need them in the market. Now, if people were paying cash for everything, house, bills, everything else, people wouldn't have money to invest. But when you use credit cards and you have a mortgage and everything else, that enables people to have more income on a month-to-month basis, which they can put into the markets, whether it be through a forced savings plan like a 401k, or maybe just through their own, maybe they're buying BlackRock stock, or maybe they're using a broker at BlackRock to do their investing for them. Maybe they're investing in a fund directly. However that might be, banks doing loans is what makes that possible. So the next group of people we're going to look at and define is going to be asset managers. Okay, so asset managers are basically a group of professionals who perform this service for others, right? They perform the service of asset management, which is the practice of increasing total wealth over time by acquiring, maintaining, and trading investments that have the potential to grow in value. So an asset manager that you might have heard of is going to be BlackRock, Vanguard, any of those companies that you might have your 401k service by. Those are the kind of companies, and they make their money by moving your money and charging you fees, and also taking whatever funds they have to invest on their own and making money on that, and their own stock. They may their stock value goes up, they make money, right? And there's many ways they can make money out of that. They get a little too complex for this conversation, but Investopedia does give us an idea of what asset management is, and we will also rely on Investopedia to explain hedge funds to us. So a hedge fund, a limited partnership of private investors whose money is managed by professional fund managers who use a wide range of strategies, including leveraging or trading non-traditional assets to earn above average investment returns. So it's often considered a risky alternative investment choice and usually requires high minimum investment or net worth, often targeting wealthy clients. This is oftentimes more of a risky strategy, but from what I'm seeing, the much larger hedge funds, they're big enough and they're concerned enough about their reputation to where they tend to take relatively safe investments. And I think last year, a lot of them didn't even beat the S&P. So not to say it's the best way to go, but you know what? When you have billions of dollars going into your hedge fund, whether you win or lose, you're taking a percentage of that, right? You're going to take fees, and oftentimes you're going to take a management fee. So the money is made in that sense. So hedge funds, oftentimes, they don't have to win in order to make profit. They just need people in. The question is how do these groups get money into their coffers? How do people get attracted to trusting these funds to make money for them? Well, of course, you got 401ks, right? But that only has so much utility, and the market will eventually kind of, it'll create an equilibrium where that 401k contribution is priced in, if you will, right? So they need to bring money in. And there are times when bringing money in is harder than others. As a matter of fact, we did have an interesting time recently because of COVID, and even leading up to COVID. Retail investing has been stretched thin, and that is because of inflation. So let's go ahead and talk a little bit about inflation. This is another Investopedia slide. It's a rise in prices, which can be translated as the decline of purchasing power over time. What this means is that you're buying the same item and the price goes up and you're not making any more money, right? Like your job's not paying you anymore, or they're not paying you enough to keep up with that. So the dollars are just worth less. And this tends to be caused by a lot of money printing. Milton Friedman says that inflation is caused by too much money chasing after too few goods, right? And you can see here how printing money can cause inflation. And this comes from economicshelp.org. You have, say, 1 million goods and you have a $10 million money supply, and then you have the average price of goods, right? Now the government prints 10 million, money supply doubles, and you actually have twice the price of the goods. However, you're not making any more money, or if you are, it's probably not going to be as much. The goods haven't changed. The utility of the goods is the same. The amount of people buying the goods is relatively the same, but there's twice as much money. So the price of the goods doubles. In a short-term sense, that can actually be very profitable for the market because stocks go up because of inflation. The problem is that people's ability to invest in those stocks starts to wane. It starts to drop because over time, they're not making as much money. This was the Weimar Republic situation in Germany, where because of World War I, and they had, I think it was the Treaty of Versailles, where they had to pay for that, and they ended up just not being able to pay for it. They just started printing money so that they could afford to make the payments for the damages of World War I, and because they were printing money, all of a sudden the value of one gold mark in paper marks just skyrocketed. From in 1918, it was about 1 to 1, and it was a trillion to 1. Wheelbarrows full of money to buy a loaf of bread. You know the whole story, right? So one time in recent history where we saw inflation being a problem was during COVID. So COVID is a really interesting case, right, for us to look at. So we will look at what happened during COVID, and we'll see how these hedge funds were behaving. Let's go back to what we've already established, right? People need to borrow in order to invest. They might not be borrowing money to invest, but if they don't borrow, they might not have the income to invest. Asset managers and hedge funds, which rely on retail investment to provide them liquidity. And it actually really provides them liquidity at important times in the market, right? There's exit liquidity and then there's entry liquidity. So look, if you're a very large company and you want to have a big position, if you're trying to buy something that is not a very big market, you're going to push the price up and you're not going to be able to get a very good price for that. But if you have a bunch of people panicking and selling, then the panic sellers are going to hold the price down and you'll be able to get a good position, which is pretty much what probably happened at the beginning of COVID when the entire market was panicking. So the system pretty much made a decision that, okay, we're going to start holding up the market at this point. And I'm not sure this happened because I don't talk to everybody, but there's a good chance that people were told when this was going to happen, and so they all went ahead and used that exit liquidity, I should call it entry liquidity. They used all that panic selling to get a good position in the market, and all those people sold while the smart money was buying. And the same thing happens at the top, right? So when everybody's panicking and buying, right, well, the smart money is selling, and they're using your buying pressure to get out at a good price. Because if these big companies all sold at the same time, then, all the prices would go down. But if everybody's buying because they think it's going to keep going, they're able to get out and not push the price down and get a good price. COVID itself was interesting. So we had the market crash, right? And that provided entry liquidity. It kept the prices down while the smart money was buying. And then you had a lot of people who lost their jobs, right? And then there was a danger in the market. There was no more 401k money necessarily because so many people weren't getting their paycheck. And a lot of people just were not getting money. So markets were looking like they might dry up. So what did they do? Well, they printed a bunch of money to shore up the banks and to inject into the market. And so the markets found their bottom. And then we saw retail traders like you and me, we were convinced to put our stimmy checks and savings into the market as people with no jobs started turning to trading as an income source. So since the market was now moving, people felt this was the only place they could make money. So they took what little they had left and started to play the market. And how were people convinced that this was a good idea? Well, it was done through the media, right? So this is when we saw a lot of news related to finance and everything from meme stocks to Bill Ackman talking his book on the news, which we'll show a clip of that here very shortly. So why is this? Why is this done? Well, because knowing the future is a surefire way to make money. Well, what if funds and asset managers could control the future? Well, they can. How is this possible? Because leading up to COVID, newspapers were losing a lot of money due to electronic media, right? Print media was going down the tube. So hedge funds and asset managers started buying them up and consolidating them. That means they were like maybe closing some down or combining them. And then when COVID hit, many more news companies were in trouble. And the same kinds of funds went ahead and continued to buy, consolidate these papers. And as of 2021, asset managers and hedge funds owned and or controlled nearly half of the daily newsrooms in the US. Now, what they can do with the news is they can do two things. They can cause people to panic buy, which is called FOMO, like we often see here with our good boy Jim Cramer, or they can cause panic by having a major fund manager talk about stocks going to zero.
Going to zero, okay, along with every other hotel company,
Now, Bill did temper this statement by saying that they're going to go to zero if things keep going as they are, but he said that sentence pretty clearly for everybody to hear, that this is going to zero. And I remember it happening because I was watching it at the time. So what they were doing is they're causing panic. And so people were selling. And that's when the smart money was buying. And then you got guys like Jim Cramer who say, buy, 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 buy. And everybody buys, right? And the smart money may or may not, but may be exiting at that time, because you can't exit and keep the price high if you are a large company exiting a large position unless you have people buying what you're selling. So that's pretty much the cycle, right? The large companies know the future because, quite frankly, they have friends that control like the whole market. And when the market's crashing, there is a good chance that they're told like, okay, we're going to turn on the money spigot. I'm only saying, I don't know this to be true. I'm just telling you what I'm pretty sure is true. And then they go ahead and they all start buying at the same time, and the market stops going down and people panic sell into their book. And then at some point, the market is going to stop going up. There are a lot of metrics to know this, and there probably is word. There's probably people who know what's going on at the top. So what they do is they'll use guys like Jim Cramer. I'm not saying him. I mean, guys like him, maybe not him. I don't want to point fingers, but they will cause people to panic by convincing people that the market will continue to go up. And as they're doing that, the smart money is selling. And that is how they scare you into buying and they scare you into selling. So the smart thing to do is to understand what you're doing, to develop a system to where you can use your own system to make money, to get in and out when you choose. And you can do that over at www.algofactory.tech. Come talk to us. We hope to see you on the next show. And remember, to trade your job, upgrade your life. All right, hope you enjoyed the show. Please like, subscribe, hit that notification bell. On the screen there, you can see our website, algofactory.tech. Tap that QR code to take you straight there. I'm also very active on X. That's algo_factory777. We got TikTok and Rumble. In the meantime, we hope to see you over at the website. Come on over, trade your job, upgrade your life. We'll see you there.